Hello, everybody. My name is Wes. I'm your financial advisor coming to you from the Florida Keys. Now, fear of missing out, or FOMO, is one of the most powerful forces in investing. It doesn't feel reckless and it doesn't feel emotional. It feels logical, feels urgent, and it feels responsible at times. But FOMO is rarely about opportunity, it's about anxiety. In this video, I want to explain what FOMO really is, why it shows up so strongly in investing and in markets, how it influences decisions, and how investors can manage it more intentionally. Let's jump right into it. So, what actually is FOMO? FOMO isn't just fear of missing gains, it's fear of being left behind, fear of being wrong, fear of watching others succeed while you hesitate. In investing, FOMO often shows up when an asset has already risen significantly, media coverage increases on this asset increase, and social proof grows. At that point, the decision is no longer about fundamentals, but about relief. Now, FOMO feels rational because it's reinforced by recent performance. When something has gone up, it feels safer, it feels validated, and it does oftentimes feel obvious in hindsight. The brain assumes recent success will continue. But markets don't reward what feels obvious. They reward patience, discipline, and planning, often quietly so. When FOMO takes over, decisions tend to change in subtle ways. Investors may abandon their original plan, increase risk without realizing it, ignore valuation or their own time horizon, and focus on stories instead of structure. The biggest issue isn't the investment itself, it's that the decision process breaks down. FOMO often leads investors to enter after much of the upside has already occurred. That does increase timing risk. If expectations are high and reality disappoints, prices can adjust quickly. This is why FOMO-driven decisions often feel good at the start, but uncomfortable shortly after. The emotional cycle tends to reverse. The surprising thing about FOMO is it doesn't disappear with experience nor intelligence. It shows up in every market cycle, every generation, and every asset class. There will always be something outperforming. There will always be a headline suggesting that you're late. FOMO isn't a flaw, but rather a human response to uncertainty. Now, you should always make a plan before investing into the markets. A clear investment plan almost acts as an anchor when emotions rise. A plan defines why you invest, it clarifies the time horizon, and it sets expectations before your emotions show up. Without a plan, FOMO attempts to fill the gap. But with a plan, opportunities are evaluated, not necessarily chased. Moving on, not all interest is bad. There's a difference between learning about new investments and feeling the pressure to act immediately. Healthy curiosity asks questions while FOMO demands actions. That distinction matters when you're attempting to make a decision or place a trade in the markets. But how do investors manage FOMO? Managing FOMO isn't about ignoring opportunities, it's about slowing decisions down. Helpful questions might include: does it align with my long term plan? Am I reacting to recent performance? And would I still want this if no one were talking about it? FOMO loses power when decisions are intentional and actually thought through. Now, to wrap all this up, FOMO is not a signal, but rather a feeling. And feelings are information, not instructions. The goal isn't to avoid missing out on every opportunity, though. The goal is to avoid missing out on your plan. Because in investing, long term success rarely comes from reacting faster, it comes from reacting less. Thank you so much for watching. I really appreciate you tuning in. As always, I'm trying to improve my craft, so if you have any suggestions, let me know in the comments below. Have a wonderful day.